disclaimers. You saw a whole slew of them before. Disclaimers here. I'm putting it in English for you. Everything I say today, it's just me. It's not the AICPA. It's not John Moore. It's not Raymond James. It's just me. Anything I tell you about today, any suggestions, ideas, things to look into, don't try this at home without consulting your financial or your tax advisors. Now let's talk about charity. So, a couple of changes, not really significant changes. The percentage of your adjusted gross income that you could take as a charitable contribution was increased. Bad news, used to be able to take a deduction. Who's the big college football team here? ASU, okay. So if you bought tickets to a box, ASU, whatever, Sun Stadium, am I right? Sun Devil Stadium. The Sun Devil Stadium, you were writing a check to the university, right? It's a charitable organization. I was able to take a deduction for 80% of the value of what I paid to buy those athletic event tickets. Not anymore. They cut that one off. So what can we do with charity? Well, number one, bunch contributions for your maximize your deduction. Here's why. Talked about at the very beginning. Your charitable, your itemized deductions, you now have a much higher standard deduction. Your state and local taxes are limited to that 10 grand. Okay? A lot of your itemized deductions are gone, like investment advisory fees. That's a big one for a lot of folks, I imagine. So you know what? You might be not necessarily taking any advantage when you itemize your deductions. So why not try to look to maximize? So in year one, make your charitable contributions for years 1, 2, and 3 even. Get that itemized deduction, and then in years 2 and 3, you get the standard deduction, you move on. Big way to do that, donor advised funds. I love these. I know John loves them. You put the money in today, you get a charitable contribution deduction today, but you don't have to decide what charity is going to get the money till next week, next month, next year. In December and January, the major firms that run these, Fidelity, Vanguard, I don't know if Raymond James has them, but I mean the custodians for these donor advised funds reported the largest inflow of money in their history because folks realized how much more valuable they are now. Another one I love, qualified charitable distribution. You have an IRA, you have to take a required minimum distribution every year. And if you've got a good financial advisor, even if you take the money out, each year you still have the same or more in your IRA. You're not reducing the value of the IRA, right? The market's going up, but guess what? The number they divide by to determine how much you have to take out, that keeps going down. So you got to take out more each year. Theoretically, it's based on the fact that they want to see, you look at your life expectancy, there's a table the IRS puts out, and they're figuring you should use it all up by the time you pass away. So every year, and it's taxable income. And what does this do? Well, not only are you paying tax on it, but it increases the amount of your adjusted gross income, which means you're paying more for your Medicare. You're paying more for your prescription Part D. So what can you do? Well, if I'm going to give charity anyway, which we all should be, rather than take the money out of the IRA and then write a check to the charity, why don't I have the IRA write the check directly to the charity? What does that do? Well, it means I can't take the deduction on Schedule A because it's not a charitable contribution from me anymore, but it also means that it's not included in my taxable income. Real numbers. My required minimum distribution is 100 grand. I take out that 100 grand and I write a $50,000 check to charity. I got 100 grand of income. I got an itemized deduction of 50 grand. Now I'm only going to pay tax on 50 grand, but I'm paying more on Medicare, I'm paying more on this. Some other things that are limited by the amount of income I can take, like tuition and fees deductions and other things, are all affected by that extra 50 grand. If I have the IRA write the check directly, I only have 50 grand of taxable income, 50 grand of gross income and 50 grand of taxable income. So I'm paying the same tax, but I'm not paying a higher Medicare. I'm not paying a higher prescription D. My income is lower for all those other things. I may be, I may be able to stay below that 200 or 250 for the net investment income tax. Like we talked about, that's 3.8%. That's of the money of the income over that amount. That can be real money if you've got a lot of dividends and interest and capital gains. So qualified charitable distributions are really, really good. Now, John referred to this. You've got a special benefit here in Arizona where you're allowed to take a tax credit for up to $800 for a charitable contribution to a specified list of charities. That's very valuable. Let me explain why. Credits and deductions. People often use the terms interchangeably. They're very different. A deduction reduces the amount of taxable income. A credit reduces the amount of tax. Real numbers. An $800 credit, $800 deduction, in Arizona, where, as I said, it's an average of about a 4% tax rate, based on your tax scale, would save me $32 in tax. An $800 credit saves me $800 in tax. That's quite a difference. That's a general rule. Keep in mind, credits are much more valuable than deductions, always. But so that's a big credit to keep in mind. So if you're looking to give charity, personally, I would highly recommend, if you're going to do it in Arizona, you look at least for that $800 for buried falling joint. You look there's a whole list of charities. I was looking at it before on my phone, that you find one of them. They're all worthy causes, and do that as part of your charitable giving. Because, like I said, charity should come from the heart, and it shouldn't, but as long as the government's going to give me an extra benefit, why not take it? Look for unexpected opportunities to give charity. Well, one, everyone in this room should know about giving appreciated stock. And I think John showed that thing, what was it, $16 million or something that folks have given out of their accounts from John Moore and Associates. You give appreciated stock. You give Apple stock that you bought at 10 that's now 100. Well, you get a deduction for 100. If you sold it and gave the money, gave the $100, you'd have to pay capital gains on $90 of it. So it's much more valuable to give the appreciated stock. And the charity, when they take that stock and go sell it, well, they're tax exempt, so they don't pay tax. Little things add up. Okay? Travel. Sounds silly. But when you drive to go work at the church bake sale, that mileage, you can deduct the mileage from your home to the church. It's limited, it's 14 cents a mile, and it, doesn't sound like a lot, but it's up. You take your daughter's Girl Scout troop on a field trip. That's, as troop leader. That's deductible charitable mileage. It adds up. Sorry, I don't mean to interrupt. What about the drive home from the event? Oh, both ways. Yeah, round trip. Right, on the way home, is that also deductible? Yeah, I'm saying, when you say from the event, yeah, round trip. It's not just driving to the church. I guess why I say, because I do a lot of driving, and I was told that even driving home from work, that I can't include that. Well, that's driving home from work. Those are different rules when you're talking about commuting. Okay, so those are very, very much stricter rules. But if you're driving to and from a charitable event where you're contributing your time and effort to a qualified charity, that mileage is deductible at 14 cents a mile. Yes. Similarly, since we're talking about mileage, let's talk about when you drive to the doctor, to your doctor's appointment. That's deductible medical expense. Now, you may not be able to use it because it's the floor, but you need to, when you look at, did I go over the 7.5%, you got to throw that in. Now, to someone like me living in D.C., my doctor is, I take the metro, it's nothing. But here, you could be driving 50, 75, 100 miles maybe to the doctor's office. I don't know. Hey, I'm going to find a doctor on the other side of town just so I can get a higher deduction. All right, you're going to like this one, though. Let's look for the little things. So I travel a lot for business. Everywhere I go, I'm in the hotels, and those little soaps, little shampoo bottles, I collect them. And I gather them up, and I bring them home, and every couple of months I pack up a box, and I send them to this local shelter that I have a relationship with for many years, and it's a charitable contribution. And you know what? Those little things, what do they cost? What is it, CVS or Walgreens around here? They're like $1.50 each. And that's how much they're worth as a charitable contribution. When I was in practice, before I worked for the AICPA, I was in practice for 30 years in New York. I had a client who was a high-powered executive for one of the networks. And he traveled probably 300 days a year and stayed in suites. I mean, and you think that what they give you in your room? They get like a box every day of toiletries. I mean, everything you can imagine. He collected them. One year, we took $10,000 in charitable contribution for the little soaps and shampoos that he contributed to a local shelter. We got audited, and we proved, but we won. So, but I mean, even if you get that trip to Cancun for 2 weeks, whatever, even if you get a 50, 100, contribute them. All your travel, get all your friends to, oh yeah, I'll take all those shampoos you don't want anything to do with. Don't tell them that it's worth charitable contribution. State and local tax issues, we talked about it, the limitation of $10,000. We're running out of time here. It's a combination of income and property. Taxes imposed at the entity level. So if you're invested in a partnership and there's a tax on the partnership itself or on the business itself, that's still deductible by the business. Prepayment, you prepaid your $2,000. A lot of folks in December prepay their estimated tax for the fourth quarter, for the January payment. That's okay. But a lot of folks raced this year to prepay their 2018 income tax in December in order to be able to deduct it in 2017. Well, they stuck a provision in the law that says you can't do that. What they didn't put in the law, but the IRS has come out and said, is if you race to prepay your property taxes, unless they had already been assessed, you can't do that either. And this is a fun one. One of the counties outside of D.C., Montgomery County, they had a special county council meeting to authorize them to accept these payments, because otherwise they wouldn't have been able to accept them. People raced to pay them, but they hadn't assessed it yet because they didn't know what the property tax rate was going to be. They don't decide that until like March. So all these people raced to pay it. It's now not going to be deductible. Some of these people want their money back. But in order to do that, they're going to have to hold another meeting and another vote to do it. Well, do you think that's going to happen? Nah. Once they got your money, it's theirs.